Hey, good morning, everyone. If you haven't clicked up above to allow StreamYard access to you, if you comment on here, which I love to see your good mornings, it won't tell me your name. So I can't see who you are. It just says Facebook user. That was a recent something that Facebook did that put that in there. So yeah, there's Kate Johnson. So it was a recent little thing that Facebook put in there that I don't know why they're doing this, but this seems to be the most reliable program I can find to literally absolutely guarantee that I'm going to be able to go live with you guys every morning at 8 o'clock. So good morning, Amy. I have been thinking about mortgages. And the reason I'm thinking about mortgages, Crystal, so did you try your cookies in Chrome and did it fix the situation with back agent? Let me know. I have stopped watching the news because all they're doing is giving us numbers now. There's so much that we don't know about. Everything is getting more and more and more sensationalized. And I'm not saying this isn't something that is something we shouldn't pay attention to, and something that we shouldn't definitely be very cautious about how we're doing everything that we're doing. But I've just stopped watching it. And we are distancing like you wouldn't believe. We had Instacart bring our groceries yesterday 2 times. Blair had them drop it at the front door. She brought it in on one end of the table, unpacked everything, and then cleaned it all off and then put it away. So we are definitely being careful, but the news has just gone absolutely bananas with all of this end of the world stuff, which got me looking at mortgages because I'd seen any number of things on mortgage meltdown. And I don't know if you have or if you've heard from your customers. Y'all, I just said when I got on here, if you click up above up there to allow StreamYard to see who you are, it's not telling me, like, I got a good morning with the sunshine on it, and it just says Facebook user, and I can't see your names unless you allow StreamYard to take a look at you. But I looked at mortgages because with the bailout or with the stimulus, that they're taking care of buyers. They're taking care of a lot of the in between, but the banks and then the servicers of these mortgages are kind of caught in the middle in an unknown place where we are right now. And as we know, uncertainty creates chaos to a certain degree. But anyway, and by the way, like yesterday was a much better day than the day before. I woke up early, I exercised, I had tea with Blair, coffee, and went and walked the dog. I did everything, got to come on here with you guys for a while. Staff meeting went great. All of it was a much better day yesterday than the day before. I think we're all going to be facing up and down days, especially as we go into April, and happy April 1st to our very first full month. It's like we're going to camp, right? We're just locked in the cabin for an entire month. Hi, Kristen, Kip, and Addison. Good morning. Anyway, so with no further ado, ladies and gentlemen, I reached out to what I consider the mortgage engineer, the technical expert on all mortgage changes that are going on in the world. And so what I want to do, if I can, if y'all have any mortgage questions or you're seeing anything, y'all's comments are actually right there. If you have any mortgage questions or anything that you're seeing out in the marketplace right now, or you're getting calls from people because interest rates could be higher, they're going to squeeze what's required, credit scores may have to be higher. It's all a real moment of uncertainty right now. So I want to bring on Mr. Gene Dupuis, who is living in the house with his wife, Brindy, and his daughter, and they are homeschooling. They are facing a lot of the same issues that we are, uncertainty stacked on uncertainty. So, and I think this is probably the way we'll be introducing people from now on, is like, here's their situation at home. and also in their professional life. But anyway, Gene, I'm gonna welcome you on real quick. Look at that! Boom!
Good morning,
did
everybody.
So, anyway, can you kind of let's back off for a second, and the headlines 3 weeks ago said record low mortgage rates, a flood of refinance. Now we're seeing they're squeezing requirements. They want you to go more conventional because that's safer. Banks are trying to raise liquidity. They're trying to sell off packages of loans, but the investors won't buy. So the only way they can get the investors to buy is to raise the interest rate on people. A lot of stuff going on in there, not to mention FHA, which is really, and we do a certain amount of FHA, not a ton, but in our market, in Southeast Texas market, people are looking to put 3-5% down, get a bunch of closing costs and get a loan. And that seems like right now that it's becoming a little more difficult. Can you kind of address the big picture and help me come down, and I'll just
I'll think you did pretty good right there. I can just get off now. No, no, that's exactly what it is. The servicing is where the big issue is, and that's where we are today. But talking about 2 or 3 weeks ago, say even almost 4 weeks ago, we started seeing rates.
Can I stop you right there?
Sure.
When you say servicer, what does that actually mean?
A servicer is actually someone that picks up the loan after it's been originated, and they're picking up for the long haul to have that maintain the servicing, meaning collect payments or do these forbearance agreements that we're going to get into here shortly.
Could we say a servicer is an investor, or a servicer
Yes.
is who we write our mortgage check to?
Yes.
Okay.
Yes, and they're a pass through for Fannie, Freddie, or Ginnie Mae, depending on the loan program that we do, which we'll also hit on as well. So they're actually paid a certain bips is what we call it. About 30 bips, which is about $300 per $100,000 per year they get. So they're typically buying those loans from originators and such, and with anticipation of receiving those bips for 3 years at least. Okay. And that goes in with the pricing. But the servicing side of things has gone to a negative now. So really they're trying to recoup that cost by not paying out originators the same spread as they once had before, because they don't know how long they're going to have to hold on to this, or especially the forbearance. I guess get a little bit further into it quicker, is that that forbearance issue that's coming in. So a lot of people are thinking that that's going to be a deferment, things like that. A lot of people aren't rich and know what the forbearance actually definition is, or what's the outcome of that. That you're not just forgiving that payment, that it's going to come back as a restructure or a reinstatement altogether, one-time payment. One thing or the other, whenever that term comes up, whether it be 6 months or if they're able to get the 18 month or 12 months. But the ultimate issue is that the servicer at this junction doesn't know if they're going to have a payment at all within 12 or 18 months, because you have another 6 months to go through the foreclosure process after that 12 months. So you're looking at 18 months of having to front the interest payments, possibly taxes and insurance, things like that with no income.
Okay,
so if you don't have any income going, you're paying expensive note.
So you're saying forbearance does not mean that the government is going to pay my loan for 6 months?
They're going to float it. They're basically not going to come after you, and you're going to come to a separate payment agreement to pay that arrearage, whether it be the insurance and everything. Is
that an arrangement with the people that I'm paying my mortgage to? Okay.
Yes, sir.
But there's very, like in every circumstance, it will not forgive the interest that I owe over the course of that 6 months, right? And likely at the end of the 180 days or 6 months, they will stack that on top of, even if it's one monthly payment, I could have a $6,000 bill come due in 6 months.
That's if they do a one-time repayment, a reinstatement. That's actually what that's called, as opposed to a repayment plan. So if they decide to do a reinstatement after that period, you have to pay all that back interest at one time, kind of like 0% interest for 12 months, something like that. You don't have to pay anything for that first 12 months, but then bam, you get hit with all of it at one time. Some forbearance agreements can come back based on income, things like that, and come up with a payment structure to stretch that over. Like say if people have to do back taxes on IRS or something like that, they would put you on a payment plan. So $12,000 will get you to pay $1,000 a month, not just a one-time, hey, you owe me $12,000. And hopefully that will help people on their month-to-month budgets.
Yeah, personal experience. That is what happened to me after the hurricane. Was I was shocked with the payment that I got, and the reason I'm telling you guys out there this is because you may have customers, clients that you need to check in with to make sure they're doing okay, and make sure you know what this means. And that forbearance agreement, which is a crazy word that all of a sudden is now part of our vernacular, is something that is negotiated or is actually pushed down right from the servicer to the borrower. Right, Gene?
Yeah, you shouldn't have Messenger on here at the same time. People are messaging me saying, "Hey," anyway, like squirrel. But no, but that is true, and that's something that's coming to everybody facing now. And explanation. Don't know how many times I'm talking about this daily for both customers and agents and anybody else that has questions about it. What's going to happen? And with that situation, rates are super low then, and they're still not bad rates now. It's just coming at a cost now, which we've never seen before, especially in my length of doing mortgages now.
So now let's move to that. So as an agent communicating to current and past clients, kind of this forbearance issue, and now if I've got a new client and I'm going to try and get a mortgage, and I've been talking about record low mortgage rates, and when I get to the bank or whoever it is that's making me the loan, that I find out my rate is 5%, something like that, something crazy. Tell me about that.
In a few cases, you're looking at that. It's anything really outside of 30-year, just a standard 30-year mortgage. You're looking at they're exponentially increased. With the standard 30-year, you're still looking at high threes, low fours in cases. When they start getting particular things, lower credit scores, mobile homes, 15, even right now, sometimes 15 years are pricing higher than a 30-year mortgage is for the first time that I've ever seen. Because a lot more people are wanting that 30-year. We want to gravitate toward that servicing distance or length of time. So whenever you're getting into those particular ones, like I said, mobile homes, I know that we do those around this area, rehab loans, anything with a bigger risk factor, smaller market to be able to find another buyer for that later on if they were to foreclose. You're definitely seeing higher pricing, and that means typically more cost out of pocket. Whereas before we're looking at par pricing on some rates, meaning that the borrower didn't have to pay any discount points above and beyond whether you're paying title fees, your escrow accounts, if your lender has any fees, things like that, that you're paying them mandatory discount points to get some of these rates. Sometimes you're looking 2, 2.5, 3, and sometimes as little as 1 on some of these programs. And there are still a few 0 or par pricing that we're getting on some conventional programs, things like that. But it definitely is looking more costly at this time because that servicing value has gone down so much that they have to make it somewhere to be able to originate these loans, to hold on to it and stay off for a certain amount of time.
Yeah. Okay.
So it's definitely making it more costly. That's the issue.
And do you consider this, and I'm assuming this is the same thing that's occurring in the FHA market that I was talking about earlier, that those loans aren't as attractive for an investor to get into or a bank to get into. So they're squeezing, even on an FHA loan, credit requirements, money down, and interest rate on those as well.
Yeah, there's been quite a few. Last Thursday was where everything hit the fan. That's where everybody started running around trying to lock rates, things like that, because they knew a lot of things were going to come down. A lot of investors, lenders, were going to start tightening up on their restrictions above and beyond what the agency guidelines are, meaning what the real guidelines, what the credit scores are allowed for FHA, VA, USDA, whatever the case may be, that they're still going to allow those programs, but they're going to go up to 620, 660, 680 credit scores. I know a few that went to 680 right off the bat. Some went to 660 over the weekend. Some have done 620. We currently aren't just yet. We still have outlets for that. It's not really a pitch for me. It's just saying we haven't yet, but it could happen this afternoon. And that's how quickly everything's changing. But we're just waiting for it. And that's what we've talked to people that are below 680 credit scores and make sure to get back in contact with them, discuss again the pricing on their situation, interest rates, out-of-pocket cost. Is that going to change their loan amounts that they're going to be able to qualify for, or their sales price they're going to qualify for? A lot of these things are going to be factors in that. And we're trying to get ahead of that to make sure that if they are still out there looking and things like that, we don't run into a surprise once they get a contract in. and having to negotiate that, because we did right off the bat have to do that. So we're trying to get ahead of the curve on that.
Sure. Well, in this situation in particular, with the uncertainty and with it, and I'm not committing you to anything, but in your opinion, because I know you're widely read and very educated on all of these things, in your opinion, how long do you think we'll have this much uncertainty, and we are speaking with customers and clients, kind of what's your feel for how long this uncertainty might be going on?
Things that I've seen and looked at is we're looking 30, 60 days out just to get a test
So
on how many people are going
it's
to try to take advantage.
not an end of the world kind of a situation. It's just in this space and time that we're locked inside.
Not at this time. Yeah, not at this time. We're looking at that, but it's going to take a little bit of time for everything to come around. Kind of like we mentioned off the air that before, unemployment had gone from a very small number, and then in a matter of a week, it went exponentially higher again to 3-something million unemployed people out there. We personally had 2 or 3 people affected directly by that we couldn't continue on the contract due to their unemployment status at this time. But that's just the getting into the contract. We're also talking about people that are already in loans and who all is going to start as of today wanting to get in the forbearance agreement or flat out not be able to pay it or something like that. We're trying to look for 30, 60 days to see how many people are going to take that outlet. And once they have an idea there, then they can budget from there or know what they need to have to offset this or what the next steps are to hopefully get it back down and get rates back where they are. Because everybody wants to see a stable market. Right now, nobody wants to have this or the uncertainty either of what's going on. They would definitely want to have that off. I did see a few places, as long as we can have what happened the last day or two, kind of stable off. Hopefully that will start helping out. And we really only need 1 or 2 investors, lenders, to start coming out with correct pricing and showing faith in the market and faith in everything else. And a lot of people start following suit after that as well.
That'll do it. Great. Good to hear. Yeah. Because a great Brian Buffini podcast 2 weeks ago, I think, if you guys out there are looking for it, with Lawrence Yun, the senior economist for NAR, which if you look in the video on Monday, I had quotes from him down there where he's talking about potentially the lowest mortgage rates again, like they may come up. Let's see if I can keep this on the screen. I'm used to being the only one on the screen, but if they come up, then they may go right back down again. And that's what he's anticipating, is again hitting the bottom and bouncing off the bottom for our mortgage rates going forward. So let's hope we can wipe this uncertainty off as soon as possible. But I was completely surprised that this is a stimulus kind of has been the catalyst for the change in the mortgage market, right? I mean, everything would be going according to normal, assuming we weren't locked down in our homes, assuming we could all pay our mortgages, and that there wasn't a stimulus injected into the economy saying we're not going to evict anyone for 60 days, and we're not going to foreclose on anyone for 60 days. And that got the mortgage market scrambling, right?
It did. I mean, refinances are still doing okay. There's still people purchasing refinances. A lot of those individuals are showing on-time payments for X amount of time, not showing that they're going to try to do something like a forbearance agreement. So we're still not seeing that really shaking up as much as you would think. Again, it's a day by day. That might happen this afternoon. But at this time, we have still been doing just as many refinances last week as we did 2 weeks before. It's really a lot more of the purchase and FHA that's really been affected drastically on the pricing and such. But again, everything else can still follow suit in the next 30, 60 days, depending on this forbearance and how many people take advantage of that. So we're definitely just going to keep a pulse on it and see what's up.
Well, so, and I guess I know you've got a call at 8:30, so I'm gonna let you go. But how's your business, just in general?
Oh, we're doing extremely well, actually. You see everywhere around.
Go ahead.
Oh yeah, year over year, we probably have about say 30% more business at this time than we normally would have.
Really?
It's crazy. I mean, just over the course of the weekend, we had quite a few contracts come in. Like, hey, people out there showing houses.
No, keep going. Sorry.
And then so yeah, we see people coming in. We actually surprisingly have it because we were starting to talk about plans, what's going to go on, how's everything going to happen. how long we have to wait it out, things like that. And then we have reserves saved up to weather the storm. But in the meantime, you still have to have the influx of business. And oddly enough, we're having just as much business come in, if not more, than we had prior to all this. So hopefully it still maintains. Hopefully people are still out there taking precautions and still showing houses however they can. Because at the end of the day, people still need to live.
I got you,
or
brother.
have somewhere to
Okay.
live.
Yeah. Well, Gene, I can't thank you enough for your time. I appreciate you coming in and kind of giving us some clarity. I will invite you back. If you're open to it, I'm going to ask all of our agents if you've got a specific question for Gene. He's obviously open to Facebook Messenger because he's distracted by it right now. So shoot him a message directly, and if that's all right, Gene. And then
I was looking at the screenshot to see if there was any questions on what got sent to me, but it wasn't. I didn't see anything. So
okay,
that's all.
And you'll come back and answer whatever those questions may be, and then I'll get back with you and we can address them in the aggregate in the future. But thank you very much. Is there anything you'd like to close with?
No, thanks for having us on here. Great seeing everybody. I did finally find the button where I can see who all was on there. Hey, everybody. Thanks for saying hi. I was on the private chat, not the live comment. I'll be better next time. But no, it was great having me. It was a great conversation. Hopefully next time, if you have me back on, that we'll have a lot better news and talk about the upswing and hopefully talk about how quickly we get everything back on track. Yes, sir.
Yeah. Okay, brother. Thank you very much.
Great seeing y'all. Thank you.
Adios.
Bye-bye.
Bye. So good morning, everyone. So, hey, anyway, I just wanted to finish with our protocols that are out there for showing properties. If you saw yesterday, and you can go to texasrealestate.com, TAR has basically copied our protocol and put it out there on one of their forms. I'm just kidding, but it is very, very similar to what we have. You should see that either from Kathy Burkhalter sending that out from the Beaumont board. You can go to texasrealestate.com or texasrealtors.com, log in there, pull that form down. If you'd rather use it than ours, it is not required. Just like the other form that they've got to allow people to get out of a deal is not required. There may be some that you feel like you need it on, that you want to protect your buyers, or you may have a shaky seller that you want to protect you as a seller rep may see a shaky buyer and want to make sure you got that form in place so that you can get out of that transaction at any time. But anyway, that's new stuff. There is also a webinar at 9:00 this morning with John Cheplack, who is super real estate coach. If you log into Main Street, you can see, and go into Remax University. In there, you can see where there's a list of webinars. You probably got an email yesterday from Adam Contos that showed you what was in there. You can log on to that and check it out. Going to be plenty to do while we are quarantined. And I know we're all dealing with multiple issues. And I realize now the highs are higher, the lows are so much lower. We are all going through it, and we'll get through this together. Let's just keep hanging in there and keep going. But that's all for today. I saw the mortgage thing. It gave me some concern because now the news, it seems, is really trying to make everything more and more alarmist to get you to click on it. And because we're all becoming a little bit numb to it, I think. And I've completely stopped watching the news 100%. I may watch a presidential news conference to hear it from his mouth and his doctor's mouth directly, but it's just gotten so distracting and has disrupted our household so much that we've all kind of just shut it off. So, boom. It's going to be a great day. Sandy Deloney was in my accountability group yesterday. She talked about scheduling out her social posts after May into June through the rest of the year. You can schedule out social posts for holidays and things like that. So she'll have all that done where it's automated. I would suggest if you've got a little time, think about doing something like that, just to stay in touch. Anyway, I hope I'm providing you with some value here with the mortgage business to allow you to communicate with your customers that are out there that have recently got mortgages or are wondering about forbearance and what that word actually means and what it means for them, that it is up to their servicer. That's actually the person you're paying your mortgage too. They will make an arrangement with you directly. It does not mean they're going to forgive it. And even if they say we're going to forgive it, it doesn't ever mean you're not going to pay that interest. They're always going to get their money out of that. A lot of this mortgage business right now actually comes from, they got to make money too. And this is how they do it. Look at what I wrote down. I wrote this down this morning, trying to figure out how the whole mortgage world works. And it's crazy, but they sell their mortgages. Banks can't just lend and still have a lot of money left over if they lend to everybody. So they've got to generate cash. They package these things up and sell them off to investors / servicers. And then they raise cash doing that. And then they lend out more money. And then they hedge against that. And it's a long, complicated process. But when you allow the end borrower to stop paying, it gums up the whole system. I think the Federal Reserve is going to come in and make sure any place where we fall down is going to be fixed. Or we'll print some money and throw it at it again and fix whatever that issue may be. And we'll keep going. It's just going to take this little bit of time where there's uncertainty, help keep your customers calm, because I think this will actually get worked out, because it's not like an underlying issue. It's merely in a chain of things that needs to happen. We pulled out one link. And so all we got to do is fill that back in. Anyway. Make it a great day, and we'll talk to you tomorrow. Be well, y'all.